Well, it was a quiet day on Wall Street. We did see most of the market indices trek a little bit higher, but it was on largely quiet volume. Of course, yesterday was President's Day here in the United States, and so it is possible some of the traders are having a little bit of a delayed return to trading. But nonetheless, it was an important day. We saw the NASDAQ and the Russell 2000 hit multi-month highs, taking out their highest levels that had been in place since December 3rd. So that was an important occurrence there. We also saw some positive economic announcements from companies like Walmart that suggested that some of their sales, even online sales, were promising, and so that helped support the market to a degree there as well. We'll actually be talking about a different dividend aristocrat company here in my trade application today, one that had a upgrade today, but unfortunately didn't see its stock advance much. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 19th, 2019. First of all, if you are new, welcome aboard. Make sure you come on over to our YouTube channel and click subscribe to make sure that you are up to date with all of the latest videos that we supply for you. While you're over there, you might want to check out our description area, which allows you to sign up for our email distribution list as well. We're also heavy users of Twitter. My handle is @BrandonVanZee. I would encourage you to follow me there. And thank you to everybody who does click like and retweet whenever you see the Market Outlook videos posted on Twitter. That does help us spread the word. And then lastly, we have a presence on Facebook. Feel free to join our group there at the web address embedded in the logo in front of you. All right, with that, let's go ahead and dive into the charts. And as you can see, I've got chart 4B pulled up in front of us. And for those of you that are premium market scholars, you're welcome to follow along with my presentation here tonight. But as a reminder, when we're looking at chart 4B, this is our kind of foregrid where we look at the 4 major U.S. equity indices. And that way we can kind of see them all side by side just to see if there's any sort of distinguishing elements towards one or the other. Now, I happen to mention one thing that caught my eye today that does distinguish these charts to a degree. I mentioned it in the intro, and that is that the NASDAQ, which is the chart in the lower left-hand corner, and the Russell 2000, which is the chart in the lower right-hand corner, both hit multi-month highs here today. You can see on the charts that the little high bubble that occurs on these thinkorswim charts is hovering right above this most recent candle today. And we also saw the same thing right over here on the Russell 2000. Didn't quite get there on the S&P 500. You can see that we're trading right here, whereas we'd need to get up and above this candle over here, and the same thing can be said for the Dow. But we're on our way, and that's a positive sign. Remember, all else being equal, we traditionally want the market to be led higher by the indices that are considered riskier by the trading community, and that is the NASDAQ and the Russell 2000. And so there's still definitely positive vibrations out there amongst market participants. Obviously, news can change that at any given time, but of course we've been bullish here on these videos ever since basically the first week of January. Remember, you can look at these background colors to determine whether the posture is bullish or bearish, and when it's green, like it was starting all the way back here on January 4th for the S&P 500 up until where we're at right now, that means we've been bullish that entire way, or at least the posture has been bullish that entire way. So that's been a really nice run, especially from a percentage perspective in such a short amount of time here. And you know, we continue to have the path of least resistance be to the upside. Now, obviously, there's always hidden dangers out there. That's going to be the case in every single market environment. But generally speaking, companies become more profitable. And, you know, markets have more of a tendency to go up than down over time, partially due to inflation, but definitely due to increased profitability and, you know, in some cases, a lack of supply of companies' shares that are available. If you look at the amount of companies that are traded from a publicly traded perspective today versus where we were about 20 or 30 years ago, it's night and day. There's way fewer companies traded today on the publicly traded markets. And so there's more money than ever chasing fewer stocks in several decades, and that creates a scenario where you see prices kind of legging higher more often than not. At least that's been the case over the last decade or so. So I guess the key takeaway is we remain bullish. Not a big surprise there. 2 out of the 4 indices did hit multi-month highs, and the other 2 are probably just a day or so away from doing it themselves. So bullish postures across the board using that market forecast posture setting mechanism. If we take a look at our next chart now, this will be chart 4C here, and this will be our 3 green arrows chart. Now, the background color of these charts will suggest whether we have what's known as a 3 green arrows signal. Now, this is a daily candle chart, so each one of these charts are 3 months in length and 1 day represented by each one of those candles. And so when we see the green background color kind of over the most recent candle, like we do right here with the S&P 500, like we do right here with the Dow Jones, like we do down here with the Russell 2000, and like we do down here with the NASDAQ Composite, that suggests that we have 3 green arrows across the board on all 4 of our major equity indices. Now, obviously, there's hundreds, if not thousands, of stocks that make up these various indices here. And so there is always going to be some that are outperforming and some that are underperforming. But generally speaking, the health of this market is reasonably strong right now. We're in a decent economy. We've got a Fed that seems to be on hold, or at least willing to be a little bit more hesitant towards potential rate increases going forward. So that helps encourage market participants to take risk, and that's what they seem to want to be doing right now, as we do have 3 green arrows across the board. Of course, a reminder that those 3 green arrows are made up of the 30-day moving average, the MACD, and the stochastics, and it's a way for us to kind of establish our trend trading abilities. And remember, if you want to become a better trend trader, you're welcome to join me on Mondays. I teach my top-down trend trading class on Mondays at 10 p.m. or 10 a.m. Eastern time. And so make sure you're checking that out if you are a premium member. And if you ever get have any questions about our schedule, remember you can check out our calendar there. So sometimes our classes are held at different times, and we did have a change here at the beginning of 2019. So make sure that you're up to date on the most recent class times there by checking out our calendar. All right, let's go ahead and take a peek here at our next chart, and this one will be our longer term chart. This is our 1040 crossover method chart here. And so as you can see, we've got the same 4 charts, and these ones are going to go back a little bit longer in time. So each one of these charts is 3 years in length now, and each one of the candles is one week in time. Now, one of the things I was mentioning last week when I was doing this video was that we were getting awfully close to seeing some positive crossovers. And what I mean by that is when we have the orange line crossing back up and through the blue line. And in fact, we've got some great news to share from that perspective, at least great if you want to be bullish in these markets. I do realize that some of you want to be bearish, and that's fine as well. But, I would say that the majority of Americans out there probably benefit when stocks go higher in price, because a lot of their longer term money in their 401ks and what have you is set up to the long side of the market. So from that perspective, it is good news, I suppose, that the Dow Jones did create what's known as a positive crossover here. This is a golden cross that we see over here. The reason I can identify that so quickly is notice that the background color of the chart is now green on the Dow Jones Industrial Average. We're not quite there on the S&P 500, on the NASDAQ Composite, or on the Russell 2000 quite yet. But obviously, if the Dow is doing it, we're within spitting distance of seeing the same thing occur here with some of these other indices as well. But remember, these are weekly candle charts, and so we don't really have an ability to kind of lock in this condition, this trading condition, until Friday is done. Obviously, it's only Tuesday right now, so we've got a long time to go. But with the Dow Jones Industrial Average, that was locked in as of last week. So we're good to go on that one. The other ones are probably around the corner, assuming there's not some sort of major market swoon that's about ready to take place. Now, just because we've got a bullish posture again, doesn't necessarily mean we're going to go on one of these big runs again, right? What we experienced back here when we got a golden cross way back in early 2016, and then when it ended all the way over here in the fall of 2018, or the winter of 2018, that was an extremely healthy run from a profit perspective right there. Just because we're getting this again here this week doesn't necessarily mean we're back to this moment in time and we should expect these types of returns for, let's say, the next 2.5 years. Now, could that happen? Of course, but we also have to recognize that this is a market and an economy from a cycles perspective that is getting a little bit long in the tooth. You know, some folks probably wouldn't even call what we experienced late last year a bear market. I know from an intraday perspective, we were actually down 20% from high to low on the S&P 500, but not on a closing price basis. So historians will have to argue this one back and forth as the years go on, but nonetheless, you know, from an economic perspective, we haven't had an actual recession yet from an economic perspective. So, you know, because we haven't had one of those in basically a decade at this point, of course, next month will mark the 10-year anniversary of the bottom of the Great Recession. Of course, you know, the longer that the recovery goes, the greater the chances that we're getting closer to the end of that recovery and a new cycle will unfold. Now, of course, we never know what's going to create the next drop in the stock market. I was listening to an interesting audio book from Scott Nations here recently called this History of the United States in 5 crashes. And it's interesting to note that while a lot of the behaviors before a lot of stock market crashes are similar, the exact reasons behind those behaviors is oftentimes different. And we oftentimes as a society can't predict that ahead of time. And so we've always got to be on the lookout for it. But it is true that when you've gone this long, typically, we are probably going to see some sort of sizable economic pullback sooner rather than later. And I don't mean tomorrow or next month or anything like that. But, you know, let's say a year from now we start a bear market. Would that be entirely surprising? No, it wouldn't be. And therefore, if we were able to have this bullish cross last for a year, remember, even a year isn't nowhere close to what we saw in this run right here, which was 2.5 years. So just be, you know, understanding of where we stand with things. Understand that while there's plenty of meat on the bone, room for improvement, profit potential, et cetera, that just because we got a huge run up the last time we had a bullish crossover doesn't necessarily guarantee that this time we'll get something similar. Okay. All right, let's go ahead and take a peek now at our next chart setup, which will be our chart 4E. This is our intermarket analysis 12 grid. Now, as a reminder, when we're looking at the background colors of these charts, the pink background colors will tell you whether we have a bullish or bearish posture using that market forecast intermediate term line. So similar philosophy as the posture that I was mentioning before on the S&P 500 and the Dow and all that. If we have a green background, it means that we have a bullish posture using that intermediate line on the market forecast. So as you can see here, when we're looking at the intermarket analysis 12 grid, we don't really have much in the way of bearish postures out there. Of course, the VIX has a bearish posture, but remember that's generally viewed as a promising sign for the overall market. Usually the VIX works inversely to the stock market. You can also see that the 10-year Treasury yield is also dwindling as time has gone on. And again, that's perhaps you know, part of the reason behind that is the Fed kind of willing to go on hold with their interest rate policy. We also see down below the agriculture commodities continue to struggle here. Now, on the other charts that are green, there are some interesting things developing here. First of all, gold. We've been all over this trade in this market outlook video in 2019, and it continues to impress. This is the day a lot of people are waiting for. Gold up 1.66% in a huge burst higher. In fact, I should probably check what's going on with our Goldfields position. Our Goldfields position was up 7% here today. Now, of course, that's a very small price security, only a $4 stock, but nonetheless, great to see a nice big mover there in one of those trades that we did. Of course, our gold position itself, GLD, continues to work. We've had that trade on for quite a long time. Also interesting to note, I don't always see this up at the top. It just happened to catch that our filled orders, we had a couple of filled orders here today for these trades that we've done here with Box and O'Reilly. Both of those were closed at a profit here today. Those were both one cancels other swing trade, and we placed those a few weeks back, and it's good to see both of them lunged up high enough here today to get us filled and lock in our profits, and we're on our merry way. Anyway, as we get back over here to the 12 grid, notice gold is making a serious move here. And this is, love this type of price action, this market behavior, if it will. Notice that it comes right down to the moving average, kisses it, bounces off of it. Spends some time consolidating, comes right down to that moving average again, kisses it, bounces off of it. Now we're trading at yet another multi-month high. We're now up about 10% on forward/GC, so this is the gold futures contracts, just over the last 3 months. So it's not just the amount that it's up, the fact that we're close to 10% in just 3 months, it's how it got that 10% and how it did it so consistently, moving higher and higher and higher, both in bearish market conditions, meaning when the stock market was lousy back here in late 2018, and also this year in 2019 when the stock market has been off to the races. So something's up with gold. As I've mentioned many times in these videos in recent weeks, it's like a poker tell, like the guy on Rounders that cracks open the Oreo. The market does not want to go lower for gold, and no matter what the circumstance, whether stocks are up, stocks are down, whether the dollar is down or the dollar is up, gold is dancing to its own tune right now, and that tune is dancing higher. So keep your eye on that. That could be a very interesting momentum type of trade that can continue to work going forward. Other things that caught my eye here today, obviously the crude oil market is an important one, and we touched multi-month highs here on crude oil as well. We are now back to this candle basically back in November as far as where we've kind of recovered to with crude oil. So things got really out of hand late last year with crude oil, put in all of these oversold cluster signals. That's what those little green dots are on the chart. Had a reversion to the mean, blasted us above those moving averages there, and now we use that moving average as a bounce or a launch pad, and we're going higher there. Of course, trading above that rising moving average, with that moving average being green in this particular case. So crude oil is shaping up nicely as well. I've been very impressed with a lot of the oil-related charts out there here recently. I think I mentioned that last week as well, that as I was going through oil stock after oil stock, a lot of them setting up with really nice, healthy bounces. And remember, if they get rocking, they can play a little bit of catch up because they haven't been holding up as well from a multi-month perspective the way that a lot of the gold stocks have. So if crude oil starts getting a fire lit underneath of it, it can really have some catch up potential to go higher as well. Notice the MLPs up here made a nice breakout move here today. AMLP was up 1.7%, and while that doesn't sound like it's a dramatic amount, notice that it did some serious work on the chart because it was riding that moving average up there, and then we broke through that prior resistance area. We actually closed at 3-month highs on master limited partnerships there, and of course that ties directly into crude oil to a degree as well. All right, let's now take a look at our next chart setup, and this will be our foreign stock markets. This is chart 4F. Again, the same conditions with the green and pink background colors there. And one of the things that catches my eye right off the bat is that India continues to struggle, and that's the one that I was concerned about a week ago, and I continue to be concerned about it. It had been doing much better late last year, but it's starting to fall apart, and it's giving us bearish postures. Well, like I mentioned last week, it's not just that it has a bearish posture that's concerning to me, it's the fact that it's the bearish posture combined with a falling moving average. Notice we have a bearish posture on Russia, we have a bearish posture on Mexico, and we have a bearish posture on South Africa as well. But notice that those moving averages are rising in those 3 cases. With India, we actually started seeing this moving average start to drift over here probably at the end of January. So it's a little bit more concerning because it's been a little bit more ongoing as far as the weakness goes. And that today was another ugly day for India. It was down 0.6%, and we're actually down 3.7% over the last 3 months, whereas most of these other foreign markets here have positive returns. In fact, really the only exceptions to that would be Russia, that's down 2% over that time period, and then Germany just barely down 0.5% down below there. But otherwise, the foreign markets have been mostly up over the last 3 months. So keep your eye on India. It seems to be a lagging area. So if you are looking for bearish trade setups, perhaps if you're looking for charts that are falling apart, there might be some Indian ADRs that you could tap into, or even just look at EPI or other similar ETFs that are out there. As far as some of the more bullish charts out there, you can see some positive movements here in the likes of Canada. Notice Canada is now up 4% over the last 3 months and breaking to new multi-month highs. We basically closed at the high of the session today on Canada, which is the highest level in 3 months. Other areas that look reasonably strong down below here. The United Kingdom also closed near the highs of its session here today and also closed near 3-month highs. So, if you're looking for momentum to the upside, perhaps there's something to be said for those areas as well. All right, let's go ahead and take a peek here at our next chart setup, and this will be chart 4G. All right, now this is the U.S. View. Remember, we were just looking at the foreign markets here a moment ago. We're now looking specifically at the United States. And you guys can probably all see the same thing I am, which is clean sweep, right? It doesn't really matter what sector you're in. You're doing reasonably well for yourself, at least if you've got exposure to the U.S. stock market in 2019. All of these charts have a green background. All of them have an intermediate bullish posture. All of them are trading above rising moving averages. That's why when you look at these moving averages, every single one of them has a green tip to it, telling us that price is above a rising moving average. That's a strong sign. Path of least resistance continues to be to the upside. So, you can see some of the bigger movers today. We actually only had two sectors that were underwater today. Healthcare lagged a bit. It was down 0.24%. And then industrials, for all intents and purposes, was basically flat. But technically, it was down 0.04%. Otherwise, all of the other sectors were up here today to a variety of degrees. We actually had some of the more defensive areas like the staples and the utilities actually as some of the stronger areas today for a little bit of a change there. So no matter what you're looking at in the United States, if you've got exposure, you're probably reasonably happy with that exposure up until this point. Now, obviously, there's always going to be exceptions to that. There's always going to be stocks that are struggling, but a diversified portfolio of stocks that look somewhat like U.S. markets should be doing pretty well here in 2019. Let's take a quick peek on over at the internet. And I wanted to remind you that if you are watching the Market Outlook video here on our website at marketscholars.com in the blog area, we try to make it nice and easy for you to engage with us on social media. If you get benefit out of watching these videos on a regular basis, we ask one and only one thing of you. That's just simply to let us know through clicking either like or a thumbs up, depending on what your social media platform of choice is. My social media platform of choice happens to be Twitter, so that's the one I keep my eye on the most, and I do appreciate the 98 of you that clicked like the last time around. Very close to that 100 like level that I oftentimes shoot for, so very, very close there. Thank you to everybody who did that. And then also for everybody that participates on Facebook, we have an easy way for you to click on that little logo directly below the video and give us a thumbs up on Facebook if you wish as well. We also have a like system here on our website. So thank you to everybody who participates in that. We really appreciate it. As you can imagine, we're a very small business, and the more reach that we have through social media, through you guys, helps get the word out about our business a little bit more, and that does help us along. So we appreciate each and every one of you. Remember that we've had a full day of classes already. I taught my dividend growth investing class today. We talked about the utilities sector. So if you're interested in that, make sure you check out that recording on our events calendar up here. And then tomorrow, I've got my strategy lab class at 2 p.m. Eastern time. I would encourage you to check that out. Now, of course, David had a class today. I believe it was his directional options strategies class. That recording is available, or should be available soon. And then tomorrow he's got his options inventory trading class at 11 a.m. Eastern time. And that reminds me, I think I said 10 with my class before, but it's actually 11 a.m. Eastern time when we teach our morning classes here. Sometimes get confused with all these different time zones that we have to deal with. But nonetheless, David's got a great class coming up tomorrow with options inventory for those of you that want to attend that live. Also, remember that while we did not have my typical class yesterday for top-down trend trading because it was President's Day and we had a holiday, I nonetheless did create the sector selector. So a quick little view at this. Just wanted to point out that real estate remained #1 for the 4th straight week. Technology popped up to #2, and then utilities rounded us out there in our top 3. I also did want to point out that energy stayed at the #11 slot, but because I've been seeing a lot more of these pops here recently, I wouldn't be surprised if in the coming weeks, at some point, energy finally gets off of the bottom and starts working its way up through the rankings once again. All right, let's now get into our trade application example for the day. So for that, I'm going to come back on over here to the paper money account, and I'm going to pull up chart 4A, which is just a normal 1 grid here, and we're going to pull up ticker symbol MCD. So I mentioned the aristocrat that had an upgrade, a brokerage upgrade this morning. Well, this is not what you typically want to see when you get your stock upgraded. Notice that McDonald's actually closed lower today despite most of the equity indices closing higher. That is not normal. Usually if you're getting upgraded by a brokerage company, you get a little bit of wind in your sails and you typically will close positive, assuming that the stock market doesn't fall apart from a general perspective. So a little bit odd there to see McDonald's get an upgrade and then actually close lower. You can see that this is a pretty ugly looking candle over here as well. Also notice that we continue to maintain a bearish posture from an intermediate term perspective on that market forecast. That's why we have that red background color right there. However, we're very, very close to going to a weekly bullish posture. And when I say weekly, I'm not talking about time, I'm talking about strong versus weak. So remember, that occurs when that green line comes out of that upper reversal zone, kind of like it did back here at the end of December. Notice that that background color of the chart went to light green. So if this green line went up above 20 on the market forecast, our background color of our chart will start going to light green as well. But nonetheless, just because we have a bullish or bearish posture from an intermediate perspective, that doesn't really tell us a whole lot if we don't have a legitimate trend in place. And I would tend to call this a little bit trendless, where we're at right now. If there was a trend here, I would call it a sideways trend. You guys can see that we've had 2 major areas at a topping out point up here at about 190. Notice right over here, probably on November 29th, and then again here on January 25th, McDonald's topped out at around $190. And then on the bottom side, about, let's call it 170 or so. We had kind of this 2 candle formation over here at the end of 2018 that formed the low at about 169 there. So this has been listless type of trading for McDonald's. It hasn't really participated with the rest of the stock market to the upside. And so perhaps it's just burning off some of its fat. Keep in mind where McDonald's has come from. We actually have a position on McDonald's in this particular account here. If I click on the quantity, you'll see that we bought it way back in 2014. And we bought it at a price of $90.11. And we basically doubled our money on this, as this is a stock that's close to $180 right now. And that doesn't even include the positive impact of dividends. Back then, it was yielding near 4%. Notice today its dividend yield is only about 2.59%. So I don't view this as a particularly attractive long-term investment right now if you're just getting started from a dividend perspective, because its yield isn't high enough. But back in 2014, it certainly was. So today what I thought we would do, since we see kind of a listless stock here, is look for a position or a strategy that would benefit through a neutral trading range, and many of you are aware of a strategy known as the iron condor that can help us with that. So in order to do that, what we're hoping to accomplish is have the stock continue to trade in a sideways pattern, and if that occurs, then we would end up making money on the trade. If that doesn't occur, then we will have some kind of built-in insurance contracts into our trade that will prevent us from losing too much money. So in order to do that, let's go on over here to the trade tab. I've actually got the trade pulled up down below as I was prepping to do this video. And you can see the strikes that I've selected here. Now I went out to the April contracts. We don't have quite as much time left now in the March monthly contracts. So I went to the April monthly contracts with 58 days. And you'll see the strikes that I pulled up down below. And these strikes are represented by usually the 20 delta. So as an example, on the put side of the equation here, notice I selected the 170 to sell. That is the 23 delta. So down below here in our trade that I've got loaded up here, we are selling, that's what that -1 refers to right there. So it says sell -1 McDonald's April monthly contract, the 170 put, and at the same time we're going to be buying a 165 put. So what we're doing there is we're basically selling a bull put spread. And the reason that we buy 165 put is in case McDonald's, just absolutely gets hammered in the next couple of months for some unforeseen reason. Let's say McDonald's, has some sort of poisoning outbreak or something like that, and the stock is down at $140. Well, that's why we are the owners of a $165 put as part of this trade, because anything below 165 we're covered. Now, we're still going to lose money, but we're not going to lose incremental amounts of money if the stock were to continue to go lower and lower and lower. Now, the same thing can be set up on the call side. So notice that the calls are the first two, the puts are the bottom two here on this particular trade confirmation on paper money. So on this one, on the call side, we are selling one contract of the April monthly contracts at the $190 strike. And we are buying one contract of the April monthlies at the 195 call. Okay, so basically, again, it's the same concept. In this side of the trade, this is the upper side, we are trying to say that we want the stock to be below 190. But if it goes way up, let's say we're just flat out wrong and McDonald's just skyrockets for some reason, maybe private equity wants to take it over or something along those lines. Well, if McDonald's went up to, let's say, $250 per share, we're covered above 195 because we would be the owners of a $195 call that we could convert into 100 shares of stock if we wanted to. Now, again, we don't want that. We will still lose money if that occurs. It's just that we won't lose more money if it went from 195 to 200 to 210, et cetera, et cetera. So what we want here is a neutral trade. And what we want is for this stock that's currently trading at about $179.25 to stay between our sold strikes. In this case, we want it to stay between 190 and 170. Now notice where our break-evens are, and I can get that by clicking on confirm and send right here. Our break-evens, basically 168.71 and 191.29. I'm getting that right kind of in this area that I'm circling with my mouse. That's our break-even prices there. So if we come back on over here to the chart just to kind of show you where that is, I could draw those on there pretty quick. So let me go to a drawn item and let's go to a price level. And I'm going to draw this first one up here. Right click, edit properties, and let's go to 191.29, which was our upper level. Click OK. And then let's do another one. Let me draw another line down below here, right click on it, edit properties, and draw on there 168.71, which is our lower level. And you can see how nicely that kind of collects basically all of the trading range of the last 3 months. As long as you think that the stock stays below this upper price level and above this lower price level, in other words, if you expect in the next couple of months for McDonald's to basically trade in the exact same range that it has for every single day in the last 3 months, then this can be a profitable trading opportunity for you. Now, if you do expect a major breakout to the upside or a major breakdown to the downside, then you probably wouldn't want to take this trade. This trade is designed with the thought process of neutrality in mind. And so we are not trying to be directional with this trading idea with this iron condor right here. So I will go back over here to our trade tab, click on confirm and send, review this one last time, ship it off, and we'll see if we can get filled first thing in the morning. All right, well, I want to thank you for joining me here again tonight. Remember that the posture for most market indices continues to be bullish from an intermediate time perspective. But of course, for those of you that don't feel comfortable placing new bullish trades, perhaps something like tonight's more neutral iron condor type of a trade could be a bit more appealing for you. But as always, I want to thank you for tuning in. Hopefully you got something out of it. Remember to click like on Twitter and on Facebook. And of course, David will be back with you tomorrow. Have a great night, everybody. Bye-bye.